Are you looking for a way to compound your earnings and grow long term wealth, capital appreciation, and a massive income? Today, I want to talk a little bit about investing in BDCs. We're going to go over a couple of tools which are very useful to understand some key data as well as the power of this investment opportunity here. Now, BDCs essentially this sits in between the investor or us and small and middle market businesses. So the BDC provides financing, they gain interest fees and sometimes equity stakes, and then they return big dividends to investors, with dividend yields often ranging from about 5 to 10 or 12%. So let's get into it. Let's find out where to get the data from, as well as look at the massive opportunities here today. This is here one of the best free resources to help you to understand business development companies, or BDCs better. Now, this has a huge amount of data that is, I guess it's possible for you to collect this data from the company documents websites themselves, but it would take you a huge amount of time. And this is data as well that is not usually presented in many investment platforms unless you're on an extremely premium platform or a premium level of subscription. And so I think this is a fantastic website to be familiar with if you have any interest in BDCs. Now, Aries Capital is the big granddaddy. It's also the first ticker there. Now, if we click on the link, it gives us more insight into the specifics for that BDC. Now we can see here the red NAV has generally been increasing over time here. So this is since 2014, so the last 10 years, we can see that NAV, the net asset value, has generally been increasing. But we can see that the price, the blue line, is fluctuating around the NAVs. So this is representing the premium here, where the blue is above the red, where you're paying more than the underlying assets are worth, or a discount, such as here where the prices that you're paying are below the net asset value being held by that fund. Now, scrolling down, we've got a little bit of information here on distribution history. This is all information you can get from other areas. We've got discount data here, so you can understand roughly how this has been trading. And down here in distribution data, we can also get a little bit of sense of, say, distribution frequency, the actual yield, both on the market price as well as the NAV. And we can get some insight here also in terms of the tax dividend data as well. So the breakdown, whether it's income, qualified dividends, or even return to capital in some particular cases. A little bit of information here in correlation, volatility, earnings, and a little bit of performance data. Now, the portfolio data here as well is also the number of percentages with the LIBOR floor, which is interesting and useful if you're getting into this in more detail. Now, these pie charts here also give you a sense of the overall industry exposure. So we can see here Aries Capital has quite a wide range of different industries that they've invested in, as well as this important asset exposure. Now, the safest loan here is this first lien or senior secured loan. So if something goes wrong with a company that they've lent money to, it's the first lien senior secured loan holders that will get repaid first. So you want to see often if a BDC is involved in lending, like Aries Capital largely is, this first lien or senior secured loan should be a big slice of the pie. We can see here some much less safer second lien senior subordinate loans. Now, if something goes wrong or there's an economic collapse or economic recession, these are probably the section of the portfolio where these loans are made are those most likely to be at risk of not being repaid. There's a little bit of equity, and we can talk a bit more about that later, as well as some preferred stock, common stock, as well as some unsecured or subordinated debt there. So this gives us a lot of insight into specific companies. Now, what I want to do is I want to go back to the main list, and what this does is I'm going to take this data and I'm going to throw it into a spreadsheet. So this is simply as simple as taking that data, copying it and putting it into a spreadsheet. Now we have this in a spreadsheet. We can see there's quite a large number of companies here. Some of these I have never heard of, some of these I would never invest in. But we've got a good set of data here to look through. Now the first thing I want to do is I want to filter and sort through some of this data a little bit. So some of the first things that I want to do is I want to try and get a market cap that's a reasonable size. So I want to just sort largest to smallest. And so, for example, as we scroll through here, we can see number 15, Capital Southwest Corporation is a market cap of $1 billion. And then beyond that, we're getting quite small down into the several hundred million or even very few less than a million. And there's quite a few here with, less than $100 million market cap. So, for example, I would be disinclined to invest in these very small market cap companies. Now, the main reason for that is that the market cap represents the opportunity really for diversification. So it's not a perfect measure of diversification, but companies with a larger market cap here are probably going to be more stable. They're going to be probably better managed. They may have been going longer, and chances are good that because they've got more money, more net asset value in their investment, they're more likely to have these spread over a wider set of companies. Now, the percentage of portfolio debt is simply a sort of a measure of what proportion they have in debt and in the proportion there in variable debt as well versus fixed debt. Now, one of the most important columns here for me is this percentage of first lien to second lien. Now, as we saw in the pie chart for Ares Capital, the percentage of first lien, second lien is relatively low at 65%. And ideally here as well, I'd actually wouldn't mind breaking this out as well to just a first lien only sort of thing. Now, if you scroll down, there are other much higher. So, for example, Blackstone Secure Lending has a large proportion in first, second lien, which is good to see as well. Now, as we scroll down, we might find down at the lower end as well with the smaller companies that there could be quite less proportions here in the first or second lien secured loans that they've made. Now, the discount premium gives us a good fix on where they are today. The amount of leverage that they're using, so a more leveraged BDC is probably going to be more risky. And as we can see here, they're all about 40-50%. So there's not a huge amount of distinction there. Now, I think this is also a really important point is the NAV return over the last 3 years. Now, I wish this data went back a little bit further, but what it can do is it can give us a very good indication of the returns made by some of these companies in terms of the net asset value over 3 years. So, for example, this is a company with an IPO date of about 9 years ago, and the net asset value return has been 81%, which is quite a substantial increase. Now, into the more mainstream, large market cap companies, Main Street Capital, for example, has a nearly 70% NAV return over 3 years, which is what I love to see. Gladstone Capital and Gain, also well regarded. Fidus Investment Corp, so again, another quite small BDC, but again, a strong 3-year gain. Capital Southwest as well. So there's quite a few here with fairly strong gains. We can see fairly large market caps. And probably another important point as well for us, as well as this market yield as well. So the current percentage yield that you're going to get on your investment today. Now, if I was going to clean this up a little bit, I might say I only want a NAV return of over 30%. Now, that's cut it down to 28 companies. Now, if I wanted to be very safe, I might say that I want the first, second lien to be over 85%, and that cuts it down further. Now, one of the interesting things that we see here as well is generally these companies are trading at a premium here. So this number tends to be positive, with the exception here of BKCC, which is definitely a smaller company. Now, as we can see here, the market yields are about 10%, with the exception of BKCC, which is a slightly higher yield, which is reflected really fundamentally, I think, in the overall net discount that it's trading at here. Now, this is, of course, a much smaller company. Now, if I wanted to relax or loosen that filter, I might do that. And we can see here then, if I was going to sort by market cap with these, Ares Capital would be nice. I don't really like the first, second lien there. Blue Owl Capital, I think, does a very good job. If you're into a little bit more risk, perhaps FSK here has a higher yield. Now, noting, of course, that FSK has changed management several years ago, so the older, shall we say, I think less effective management has been gone. Since that time, they've improved their lending practices. They've improved, I think, the scrutiny of the companies they're lending to, and I think the new loans have much lower accrual levels than the older loans under the old management. Main Street Capital is a slow and steady grower, so the total NAV return has been very good. Their market yield is not splendid, but it does grow. So this is one of the few BDCs which actually has an ongoing growing dividend yield as well. Now, of course, there are a couple of others, and we will go over these as well in other videos. But I just wanted to show you what I think here is an absolutely splendid way of being able to access some really important and useful data that is free And ultimately, it's very difficult to get the data from other sources as well. Now, we may ask, can we actually succeed investing in BDCs? Now, this calculator, and there is some details in the link down below. This calculator looks at either since 95 or on the inception of the company's float as an IPO, and we can see here ARCC, the largest BDC by asset compared to S&P 500. Now, the top chart here is with the dividends reinvested, the bottom chart is without dividends reinvested. Now, of course, reinvesting dividends may have a tax implication, but we can see here if we had reinvested the dividends and $10,000, we would have outpaced the S&P 500 by roughly 50%. Now, this is a relatively reasonable annual totalized rate of return here of about 12.5% compared to the S&P 500's 10%. Now, one of the beautiful things about this is the S&P's been in a massive bull run, but the ARC stock hasn't necessarily been benefiting in quite the same way, but instead what it's been doing is it's been compounding these dividends very strongly. And we see the impact here really in this bottom chart without the dividends reinvested. So the actual return without dividend reinvestments are quite low. This is in a bull run, remember? And essentially what you'd see if the market was going flat or if the market was going down somewhat, a company like ARCC, a BDC, which pays out hefty dividends, and you reinvest those dividends, you get a beautiful compounding effect. So you get more of this type of chart up here. Main is paying monthly dividends. And as I noted before, the actual dividend payouts on the lower end for a BDC. However, Main does have those equity investments, and so there is a strong underlying growth as we can see in this lower chart. Now, this lower growth here in the black line presenting Main is showing very strong actual underlying company growth here that outpaces the S&P 500. Now, if you throw in and reinvest the dividends on top of that, you are looking at substantial outperformance since 2007. And this is looking at then a total annualized compounding growth rate of about 16 to 17% per annum, which is very powerful indeed. So let me know in the comments down below, are some of these BDCs companies that you are invested in? And if not, why not? And what would change your mind about this?